Hello everybody and welcome to another Patreon Q&A. So what I did is I locked the post on Patreon because I'm just going to do the 6 questions that I got, and then I'll do another post and then I'll lock it again because it's tough for me to go back to the post when questions get added after, say, a 24-hour period. So these Patreon Q&A videos, I'm going to make a post on the Patreon, leave it on for about 24 hours, then close it. And so if you didn't get your question in, you can get it into the next Q&A that I do. All right, so I have 6 questions today. The first question is STRK. And I remove your names from there. I figure you would appreciate that, but you'll recognize yourself in the question. So the first question is STRK. Is STRK worth the buy for someone who wants to diversify? Well, STRK, MicroStrategy's new issue, right, released today, it's IPOing today. It's good for a certain profile. If you need income, if you're a retiree, if you recently quit a job, I think it's a good fit. But I think over the long run, STRK will underperform MicroStrategy. Why? Because we know that Saylor works for the common stockholder. He's trying to maximize the returns for a common stockholder, as any CEO should. Well, he's the executive chairman now. But that's the way it works. But if you want to own STRK because you need income, I believe it's a good choice. No financial advice. Keep in mind 2 things. One of them is tax efficiency, right? If you receive a dividend, you'll get taxed at the dividend rate, which is typically less tax efficient than, say, just owning MicroStrategy shares and borrowing against the shares. Also, keep in mind there's other ways to earn income in MSTR if someone is willing to take a little risk. For example, some people have been writing covered calls on their MSTR shares, and if you write them way out of the money, you generally can get in a situation where 99% of the time you will not get called. And so that's what some people do to earn income just on MSTR. But like I said, this fits a certain profile, and I think the performance of STRK will not be too shabby, especially if they drop interest rates. And watch my last video on this topic for more information. Okay, another question. This one is going to be a longer one. So someone's new to finance and they're asking me how do I do my valuation metric? How does it work for me? How do I look at things like debt, cash, etc.? So, and I will address this in another question in a second as well. But as a reminder, so I have 3 buckets. I have my Bitcoin-based investments. This is pure debasement plays. That would be the MicroStrategy bucket. This is all about the devaluation of the US dollar and betting on another asset that cannot be devalued because it is capped. And that's the idea behind investing in Bitcoin miners, behind investing in MicroStrategy. It's gold 2.0 if you want. And the Bitcoin-based investments, right, it's what the channel is named all about, beating the denominator, beating the devaluation of the US dollar. That's one bucket. Obviously, debt, cash, EV doesn't apply to that bucket. And then I have 2 other buckets. One of them is the highest quality, and I don't care at all about the valuation. I just look at the highest quality I can find. And this bucket includes stocks like Tesla or Palantir. And you can see that Tesla and Palantir in my spreadsheet, they don't score very well, do they? No, they don't. They don't score well. That's because I just select them for quality regardless of valuation. And then I have good quality stocks, which I select mostly because they are good quality, but mostly because A star or A1, if you want, they have a low valuation. That's the first and foremost reason why they have a low valuation. So if you take a company like LifeMD, why do I own LifeMD? Because it's almost 3 times cheaper than HIMSS. I think HIMSS still qualifies as both. HIMSS qualifies as highest quality and low valuation. Still, LifeMD is not the highest quality, but the valuation is so low, being 3 times cheaper than HIMSS. I believe it's worth investing it in a value investing type of way. So I hope that answers your question. Now, regarding the valuation metrics, when you ask about debt, cash, and enterprise value, you're probably asking, why do I use enterprise value and why do I not use market cap? Well, I think one needs to understand that a main reason why people still use market cap is because inertia. Back in the days of the newspapers, market cap was heavily reported and enterprise value was not commonly computed. It was not that easy to compute enterprise value. Today we have live tools that make it very easy to compute enterprise value, and enterprise value is simply market cap plus the debt. You penalize the company for having debt minus the cash. And I think it gives a much better idea of how much you're paying for the company, because a company may seem cheap if it has a lot of debt, right? A company can have a lot of debt and it looks cheap, but the enterprise value may actually be huge because the debt is added to the market cap, because that debt, the assumption is that that debt is going to have to be paid off at some times. And same for cash. Cash should be removed because cash is easily sellable for any factor market. So really you're buying a company with a bunch of cash on it. It's kind of like you go to a garage sale and you buy a safe and it's got cash in it, right? The cash that you get is not really something you're paying for because it's cash. Okay, you don't have access to it. It's in the safe, but it's still there. And so that's why you remove the cash. That's why I use enterprise value. I think it's a better metric. And I think this is a consensus idea, by the way, that enterprise value is a better metric than market cap. Now, if you're asking me about things like revenue growth, why do I focus on revenue growth? Because this is the number that doesn't lie, right? Revenue growth, it's tough to predict. So that's the issue with revenue growth. It's tough to predict what it's going to be. And many of the comments I get in my comment section is, oh, sometimes I'm too optimistic on what I expect for revenue growth. So tough to predict, but it's also the only way a company can grow. Because you see, if a company is not growing revenue, it is drowning compared to the money stock ever growing. The money stock is growing at 15%. I say 15% a year. We have 15% more dollars out there every year. A company needs to grow the top line, the revenue. It needs to take in 15% more money each year just to stay afloat. And a company that doesn't do that, well, in my view, they're going to fall in trouble. And so also, why don't I use earnings? Because earnings can be manipulated. If you look at, say, an example of a stock like Apple, Apple's earnings per share keeps going up, but the revenue hasn't been doing too well. It hasn't grown at 15% at all. Why does earnings per share keep growing for a stock like Apple? Because they keep buying back the stock. But fundamentally, this is not what I consider a growth stock, because they're not taking in more money. There's other reasons why using the revenue. I use the revenue because it doesn't lie. It's the number for sales, right? It doesn't lie. It's not like you can't do some financial engineering to show your earnings are up with revenue. Revenue up does not lie. And so, and forward revenue growth is a number that I usually use analyst numbers, and sometimes I have to come up with it because analysts sometimes are too unconnected to the stock, or sometimes they just don't have any data. And the revenue TTM, that's simply trailing 12 months. So I use the past 4 quarters. Sometimes I debate whether I shouldn't just use the last quarter and do a 4x. It could be more accurate to do it that way as well. But I use TTM because that's kind of the standard. And my enterprise value over gross profit over revenue growth number here, it's a spin on the PEG ratio, price to earnings to growth ratio of Peter Lynch. But I use gross profit. That's why a good number in the EV over GP over RG is closer to something under 0.5, because gross profit is higher in the income statement. And the companies that I invest in, of course, to be eligible for a spreadsheet, they have to be optimized for gross profit. At the very least, they have to be optimized for gross profit. And why do I use gross profit and not, say, EBITDA margin? Because I argue always that EBITDA margin is much better than net income margin. But why gross profit? Because you see, EBITDA margin is going to be impacted by your investments in R&D, your investments in marketing. If you want the business to grow revenue, you have to invest in sales and marketing. You have to invest in R&D, sometimes as G&A. You have to pay your best executives. So the point is, there's a trade-off between the speed of growth and the EBITDA margin profit for the bottom line, proxy for the bottom line, right? There's a trade-off. If you want to maximize your bottom line, you're often going to forego growth. And that's why I always hate when companies try to maximize the bottom line, because they're forgetting about the top line growth. And that's why I think it's more fair to use gross margin, because gross margin, once you're optimized for gross margin, it's pretty stable. And then I just want to see them invest in that growth, knowing that eventually the profits will come. Eventually you will hit a ceiling on the revenue growth and the profits will come. So this is kind of in a nutshell my view. And you can see here an example of stocks that qualify as good quality but the cheapest, right? TMDX very cheap, GCT is very cheap. I don't own GSCT, by the way. I own LifeMD, HIMS, and TMDX, and they're not GCT because of a Chinese overhang over this stock. Is why I don't touch this one. The point is, I think these stocks all qualify as cheap. I could put HIMS in the highest quality, but it doesn't belong in highest quality because this is also so cheap. But if you look at stocks that I own that are very expensive and where my spreadsheet screams sell, 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 it would be a stock like a Tesla or a stock like a Palantir. You see, even if I assume Tesla grows at 49%, which is my number versus analyst number of 12%, Tesla is a 1.43. So Tesla looks expensive any way you look at it. On a price, on an enterprise value to forward revenue, between 8 and 11 times forward revenue, that's expensive. Look at Palantir. Palantir is 55 times forward revenue. That's nosebleed. But clearly the valuation of this company has nothing to do with how undervalued they are or traditional metrics. This is all about the exponential growth potential that these companies could have in the next 10 years and it being discounted. So coming up to the conclusion of, say, I want to own Palantir, I want to own Tesla, you can only come up to this conclusion by doing a qualitative analysis of the stock and being fully qualitative in your analysis and almost entirely ignoring the numbers. For these stocks, you need to do less qualitative analysis and much more quantitative analysis. The quantitative analysis can be enough to convince me to own these companies because I love the numbers and how much lower are they going to go, right? The lower they drop, then they get noticed and you get even more value investors into the stock. So these are my 3 buckets of investing. They are different styles and I believe they all work, but of course no financial advice. Moving on to the third question. This is a three-pronged question. So first of all, ETH. My thoughts on ETH. I still have some old ETH just in case, but I think it will underperform Solana. This is yet again a consensus idea right now, I think. The reason is I used to be bullish on ETH. I'm still bullish on ETH because of the stable coins, and a lot of the stable coins are being run on ETH. But really, you've seen recently stable coins move to Solana, and Coinbase actually might be a stealth play on ETH. I sometimes wonder how much of the money on ETH is actually made by Coinbase via their base layer 2. Is sometimes something that I wonder about, and I do own Coinbase, so maybe I have more exposure to ETH via Coinbase than I do via ETH, the token itself. But as far as a token for a smart contract platform goes, I prefer Solana. So I hope I don't answer some of your question. CorMedix, let's talk about CorMedix. Why haven't I bought? Well, it may be a mistake. Now, CorMedix is trading it at the 11, so it looks like I'm going to have some puts that are going to hit. I am trying for 2025. Part of my goal of 2025 is to introduce more cash-secured puts in my acquisition of companies, and so I wanted to buy CorMedix. I've been writing puts on it, and I hope I get assigned on February 21. TGTX is the same way. I hope I get assigned on TGTX. Very bullish on Briumvi, but I haven't been assigned and the stock's been going up. So it's a risk I'm willing to take. I'm willing to take missing out on the upside in order to collect the premium, but hopefully it drops and I can collect the premium and still get to buy the stock. But we'll see. We'll see how this goes, but I haven't bought stock outright. CorMedix, I've been trying to enter through puts. Part of my new goal for 2025 is to incorporate more options in my acquisition of companies and my selling of companies if I ever decide to sell a stock. But I rarely sell a stock, as you know, on this channel. I'm a buyer of stocks. I'm gonna be a net buyer of stocks forever. Anyways, and the last question is about a company like Zim, which is a shipping company. I didn't look at DAC. But all I can tell you about Zim is you're asking me here, what about the cash pile? The cash pile is more than market cap. Well, yeah, it's true, but they also have 5.8 billion of debt. So this is why it's important to use enterprise value. If you use enterprise value on Zim here, it's 5.69 enterprise value, and you can see the market cap is 2.15. So that means there's a lot of debt on that balance sheet. Yeah, it's a company that's very cheap. Priced under 1. They pay a dividend, but the dividend in these shipping companies tend to be inconsistent, so it's an inconsistent dividend. They have adjusted EBITDA in the 20%, so it's an income play. Retirees will like it, value investors will like it, but it's not for me. I'm not an income investor, so that will be my general thought on shipping companies. Yeah, they're printing cash, but they're also income investors. Stocks, and they're all about paying you income, and I'm all about growth. So that's the reason why I'm not exploring position in shipping companies in general. Then, what are my projections on MSTR right now? Seems like you changed my mind regarding higher horses. No, I haven't changed my mind. I'm still very bullish on SMCR, but you gotta realize where I'm coming from. My cost basis is under 40 on this one. I've been covering. You can go back to the channel. I was covering it about 2 years ago. SMCR when it was much cheaper than now, and so it's a long-term hold. At this point, it's going to be a forever hold for me because there's no way I'm paying capital gains taxes on a more than a 10x or just about a 10x. So that would be silly to sell it. So I'm stuck on this one, and these are my predictions. And on the Patreon, you can open the full spreadsheet and see the numbers. I don't know yet if I'm going to make this video public or not, so that's why I'm hiding between 2030 and 2035, because the numbers get crazy. This is like trying to predict Tesla 10 years out, trying to predict MicroStrategy 10 years out. You get into crazy numbers and 5-digit price targets, and it already gets crazy. And I already look crazy because my bull case scenario was already showing a $10,000 share price target in December 2029. So anyways, I don't want to seem silly. That's why I don't put it in there, but you have it on the Patreon. And you can see the CAGR that I'm expecting is in the 50% for MicroStrategy. This is not financial advice, of course. This is just entertainment, as you well know. Moving on to another question about the crypto cycles. This is interesting. Do I believe in crypto cycles? Well, yes, I do. I've been into crypto since 2015. Made the mistake of selling it too early. My biggest mistake in my life was selling Bitcoin at $250 a Bitcoin. I'm still sour about that one. But you learn, and so I believe in the cycles, winters and summers. You're always tempted to say this time it's different. I'm tempted to say this time it's different. I was tempted to say this time it's different in 2021, and I was tempted to say this time it's different in 2019. So I'm gonna refrain from saying that. All I'm gonna say is there's so many positives happening right now. You could have an elongated cycle, right? You could have a cycle. It's a 4-year cycle typically. What you could have a cycle that's 6 years. Why not? And the reason why I say that is because we may see a decoupling from the halving. We may see a decoupling for the halving. Because the 4-year cycle is, of course, based on the 4-year halving. We may see a decoupling from that for a little while because we have all of these strategic Bitcoin reserve investments being announced all over. And so is that going to really happen? If that really happens, I believe we could have an elongated cycle. But eventually, once this becomes habitual and once central banks actually, buy Bitcoin, let's assume we get into a world where central banks buy Bitcoin on a regular basis, I believe it would be too risky to say we're not going to have a bear market again. I think we'll have a bear market again, probably not as violent as what we used to have. Probably not as violent. My point on this is I don't plan on selling MicroStrategy during the bear, as I've said, but miners are perhaps up for sale during the bear, and it all depends how high they go. If they go too high, I'm not going to be interested in paying that capital gains tax, and so I'll keep them. If they just go up a few times, if it's a 2x or a 3x, then I'll be like, okay, I'll just sell it. But the key is identifying the top, and it's very difficult to do, and I may not be best suited for doing that because I'm not a technical analysis type of person. So anyways, and the last question is about an AI drug discovery stocks. So there's a lot of those, by the way, ARKG, if you look at ARKG, Cathie Wood's ETF on the space, she specializes in these expensive companies that are pre-revenue, as I'm going to call them. And this one, Recursion Pharmaceuticals, RXRX, it's definitely a pre-revenue company. In fact, it's trading at 40 times sales, which is essentially saying they really don't have any sales right now, or next to no sales, but they have a thriving pipeline, and I see some very promising things in oncology. And so yes, advanced solid tumors, if they actually had a phase 3 on that, and same for lung cancer, they actually got to a phase 3 on that, that could be an enormous market. The problem is that, of course, it's a race. A lot of people are working on this, and selecting this stock would only require qualitative analysis. I don't think you can select this stock based on the numbers. And so I do prefer a stock, for example, like Genmab. If I look at Genmab, they're profitable. They score very low on my spreadsheet. They're making money right now, and they have a big pipeline. Granted, the cancers they're trying to address are not as big as, say, solid tumors or lung cancer, but they have a big pipeline as well, and they're trading at 3 times sales versus 38 times sales. And so that's why I prefer companies that have a pipeline and also have a product that is already selling in order to give me some downside protection, some margin of safety. This is a pre-revenue company, and I want to be able to analyze those, but it's yet another thing that I need to invest a lot of time in, and for now I'm staying out of those because I don't have the time to analyze it. That's the honest answer right here. But anyways, thank you all for your questions. This was not investment advice, not financial advice. This is just entertainment. Please like, please subscribe. Follow me on Patreon, which you already do. Thank you. Follow me on X, and have a wonderful, wonderful day.